Ladies and gentlemen, good morning and welcome to Vascon Engineers Limited Q1 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Dr. Santosh Sundarajan, Group CEO, Vascon Engineers Limited. Thank you, and over to you, sir.
Thank you. Good morning, everyone. I welcome you all to the earnings conference call of Vascon Engineers for the first quarter ended June 30, 2023. Today joining with me on the call is Mr. Somnath Biswas, our CFO, and our investor relations team, Stella Investor Relations. I believe you would have gone through the Q1 FY24 financial results and the results presentation uploaded on the stock exchanges and on the company's website. Q1 FY24 saw an excellent start of the year for the company, with all elements of our businesses performing well. We have been in our past calls indicating that the management has been focusing on the basics of each of our segments, and this has yielded phenomenal results. Our improved cash flow profile, backed by sale of some of our non-core assets, better operational efficiencies in the EPC segment, have resulted in good traction. The reduction of this high-cost debt has allowed us to upgrade our credit rating from CRISIL, and it has opened up avenues for the company to carry forward the growth cycle that has started in the years gone by. Over the last 8 to 10 quarters, you would have seen that we have been guiding for improving quarterly run rate, and this trend continues in Q1 FY24. With an order book at over 3 times of FY23 revenue, a strong balance sheet, high efficiency of all business segments, and our overall improved financial position, we believe we are well positioned to continue on this growth trajectory in the coming quarters. Let me now take you through each of these developments in a little bit of detail. Our improved funding position. As we have been informing you, our credit rating has been improving, and with CRISIL rating has been upgraded to BBB+ from BBB for long-term facilities, and has been upgraded to A2 from A3+ for short-term facilities. We have commenced applying for enhanced PG limits also. We are happy to report that we are in the final stages of getting those limits enhanced, and this will allow us to significantly increase our order book position and continue the EPC execution run rate. Currently, the company has a working capital limit of rupees 300 crore as of Q1 FY24 and expects to increase this limit to rupees 400 crore by end of this year. The ratings have also helped us negotiate better interest rates, which we are currently doing with the bank. EPC execution and order book. During the quarter, EPC revenue increased 6% year-on-year to rupees 145 crore in Q1 FY24. Our EPC order book has been robust throughout the year. We started the year with an order book of 2127 crore and executed an order book worth of 147 crore this quarter. We are hopeful to bag a couple of orders in the next 2-3 months, which will increase the order book by more than 1,500 crores. We have already won some large orders wins at the beginning of the current financial year, with some projects such as the Maharashtra State Police Department for construction of residential and amenity blocks worth rupees 380 crore. Execution of new orders will have positive impact on revenue from second half of the year. Our total order book as of Q1 FY24 stands at 1980 crore, which forms almost 3 times FY23 revenue. This provides strong visibility for the EPC revenue growth for the next 2-3 years. Of the total orders, external EPC orders are around 1,600 crores, and the balance 383 crores are from internal orders. Further, almost 78% of the order book is towards government projects, which provide visibility of faster execution and uninterrupted cash flows. Real estate continues towards growth momentum. Coming to our real estate business, as we have been explaining for some time now, the nature of the bookkeeping treatment in terms of Ind AS requirements means that there will be some timing differences between booking of expenses and booking of revenues. Now that a large part of our real estate project portfolio has been completed, we will start seeing a positive reflection on the results from our real estate business segment from next year onwards. Our new sales booking in Q1 FY24 stood at 37,909 square feet for a total sales value of rupees 41 crores. During Q1 FY24, our real estate revenue stood at rupees 11 crores and EBITDA of rupees 4 crores. The gross margin came in at 64%, while EBITDA margin at 36%. We are hopeful for maintaining the momentum in real estate segment as we complete projects and have a good pipeline ahead. We are also tying up with realtors based in Pune, Mumbai and Coimbatore. In our real estate segment, we have already launched one project in FY24 and we are currently in the process of launching 2 more projects in this year. However, current year decline in real estate revenue will be compensated by EPC sales for the year so that the total top line would be maintained compared to the previous year. Lastly, the GMP business has started showing better performance now and it has continued to deliver sustainable performance in the past quarter as well as the full year. Revenue of rupees 56 crores from Q1 FY24 and gross margins of 32% have been reported by GMP. EBITDA stood at 3 crores with a margin of 6% in Q1 FY24. Debt reduction continues. The company has been repaying a significant amount of high-cost debt over the last 2 years, and this has helped the company bring down its finance cost substantially during this period. We are happy to report that over the past 24 months, we have reduced our gross debt by 48 crores, which stands at 165 crores as on June 30, 2023, as against 214 crores as on March 31, 2021. However, during the quarter, gross debt has increased by 31 crores, majorly on account of entering into new joint venture for real estate as well as higher utilization of CC limits in EPC. Before going to our financial performance, a little update on the overall industry scenario. The government infrastructure, private sector manufacturing commitments and associated incentives, according to the industry, are the main drivers for Indian construction industry's bright outlook. It also included 20% rise in income and an increase in investment over the following 12 months. Infra investment has grown as a result of the government's announcement of the National Infrastructure Pipeline, which is expected to cost $1.4 trillion, and the National Monetization Pipeline, which will generate $70 billion in new assets between FY20 and 25. The housing market in India is anticipated to maintain its pace, with sales growing at a rate of 9% year-on-year in the current year FY2023-24, and it is supported by a stable and strong demand, according to the India Rating and Research. In 2023-24, it is anticipated that Grade 1 players would see improved liquidity and sales growth of 15 to 18% annually. In the top 8 Indian cities, residential sales are projected to rise 18% year-over-year to 392 million square feet compared to 22-23. This was primarily supported by a steady and robust demand. Coming to the financial performance of the company in Q1 FY24. On the overall financial performance, let me start with the standalone numbers. During Q1 FY24, the company reported a total income of rupees 152 crores as against 143 crores in Q1 FY23, which is a growth of 6% year-on-year. In Q1 FY24, EBITDA stood at rupees 15 crores as against rupees 15 crores with a marginal growth of 4% in the corresponding period last year. EBITDA margin was at 10%, reported a net profit of rupees 11 crore in Q1 FY24 against rupees 10 crore in Q1 FY23. On a consolidated basis in Q1 FY24, the company reported a total income of rupees 209 crores as against 203 crores in Q1 FY23, which is a marginal growth of 3% year-on-year. The EBITDA stood at rupees 19 crores with EBITDA margin of 9% against rupees 18 crores in Q1 FY23. And a net profit of rupees 12 crore as against rupees 11 crore in Q1 FY23. To conclude, we would like to reiterate that the company continues to be focused towards building a strong business with focus on execution of our projects, efficiently deploying our capital, and increasing our order book while maintaining financial prudence, which will enhance our profitability going forward. With this, we can now open the floor for questions and answers. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, if you wish to ask a question, you may please press star and 1. The first question is from the line of Himanshu Upadhyay from O3 Capital. Please go ahead.
Yeah, hi. Congrats on good set of results or improving results. I had 3 or 4 questions. The first question was our order book has been flattish, okay, for EPC business. So if we look at FY20, it was around 2,060 crores. And if we look at just the external order book, which was peaked around 2,019 crores in FY21, which is down to 1,597 crore currently. Can you explain the reason for it? Because what we have been hearing is the last 3 years have been good for everybody. Order book is increasing. But our overall order book remains flattish or has not grown that much. And how big a challenge will it be for us to grow if our order book remains around this level? Yeah, that's from my side. Hello?
Yeah. Good morning.
Yeah, good.
So, you are right, the order book hasn't increased over the last year and a half, couple of years. So basically, we have been only booking orders worth what we have been extinguishing in the last year. Last year, we had certain BG constraints and we couldn't, exceed our order booking target. We have increased our BG limit this year by about 40-50 crores. And we are in the process of now getting further increased new assessments based on our last year's balance sheet, which is significantly improved compared to the year before that. So these improvements with the banking facilities are going on. Currently, our rating has improved. So we are very now positive that in the next 3-4 months, we'll have much higher BG limits and lesser constraints to book orders. Having said that, I would like to appraise you that we are, very much on the verge of bagging more than 1,500 crores of orders. We are, at the last stages of negotiation in quite a few projects at this point of time. And we can hopefully, look forward to some announcements in the next few weeks. And yes, we will be targeting to have an order book closer to 3,000 crores rather than 2,000 crores because next year we want to grow our EPC revenue to at least 1,000 crores. And for that, we need to start the year with 3,000 crore order book. So that is definitely a target and we will achieve that.
Okay. And second was, in one of the older calls, we stated that a government road was going to pass through our land in Thane. And it was believed that it will lead to substantial sale of land to the government. Okay. What really happened on that? And is that road really now passing or not passing? And any updates on that?
So in the DP plans drawn out, unofficial DP plans that came out with there is definitely a road that is passing through our plot of land. This activity of acquisition was picking up pace, but our government keeps changing. So currently the activity has slowed down. But definitely the road has been indicated. So whoever is the government, the road is there. Sooner or later, acquisition will start, and then we will have to deal with the government and sell our land to them, which will be a good thing for the company. But as of now, this was active 6 months ago, but as of now, the activity from the government side has been, put on hold or is slow at this point of time. But the road is definitely there.
Okay. And one more thing. We have stated that we'll need to buy more land to make it contiguous or continuing. Okay. to have the road frontage, okay. But we have said that we are capital constrained or we have those issues. But as we delay more and more, can there be a substantial cost increase and let's say if the construction happens in the nearby places, so what can be the future challenges to getting that land monetized? Okay. Just to understand from that point of view.
Yeah, so see, as construction is happening all around and, as you said, the price is only increasing, which is only a good thing for us as a company because what we own, we definitely own. So, even if it is not contiguous, the price of it continues to increase as development comes closer and around our land, which is always a good news for the company. As to do with, acquisition cost of the balance increasing, of course, if our land cost is increasing, the acquisition cost of lands around us is also continuously increasing. And in any case, we had taken a stand 3-4 years ago that, we are not having the kind of capital needed to focus on that. And I think as a company, we feel that, our capital and bandwidth is much better deployed in growing our businesses, real estate and EPC elsewhere. We are not so strong in terms of, cash balances to go and start acquiring lands around there. So our strategy remains the same. At one point of time, we will be looking for a partner who will, bring in the funds to acquire those lands. We can then separate and both of us could end up with contiguous land. So we are in talks with a few developers. Quite a few are interested. It is very prime location. I think when the time is right and when someone really wants to acquire a bigger fish, wants to acquire those parcels and probably wants to acquire our parcels as well, that is when we will strike a deal and see what best we can liquidate for Vascon.
One last question from my side. See, this Powai land is what we got from selling our stake in the Goa hotel. If you look at the revenue share, okay, and the value of our hotel property was 45 crores, okay. And if we look at our share comes to 118 crores or somewhere around that, okay. And we'll be doing construction also. Even if we assume 3,500 rupees of construction cost, what we are going to get means around 55 crores would be going to construction expense. So what we'll be getting is 50-60 crores only in that project. So it is when we bought this land or from Royal Orchid, our expectation was this will be a big value creator, okay, for the land. But what we see is even after 2 or 3 years, the value seems or the Excel or the presentation what you have given, the cash what we'll be getting is only around 60 crores, okay. So what are your thoughts and what happened, okay, in that place?
No, so firstly, the reason we took that land is because we have been trying to get an exit from Royal Orchid. To understand, we were a slightly minority partner in the hotel in Goa, and we've been trying to get an exit from that project for almost 7-8 years, which because of the pattern of shareholding, we were not, ever able to strike a deal. And so, therefore, this was a negotiation with our partner in Royal Orchid to give us an exit from there and in exchange for the land in Powai. So at the end of the day, you have to realize, we can, on books, we can say we had 45 crore, 50 crore in Goa, but that was not going to be realized so easily in terms of sales. And this at least helps us liquidate, do a project and liquidate and exit. To do with your estimate of, 60 crore, I think what the last time in our meeting, the real estate team was indicating more than about 80 crores of free, profits and cash flows to Vascon share from this project. But I think I will revisit the numbers and, we can discuss.
Yeah, I'll just confirm the number. So what you are looking at that number, typically you are looking for from the real estate perspective, what is the Vascon share of profit. But the understanding is that since it is a third-party entity has been, the Vascon division is there, so officially Vascon is supposed to get a construction contract on the same also. So that construction contract also is some. So if you look at from the Vascon perspective, the yield is higher. What you are looking at the number, the overall yield is higher in this project. And the second thing is that typically if you look at the project needs say almost more than 30 to 40 crore investment in terms of the approval and permission and approval, all these concerns. And there is no point of borrowing fund and servicing it for a year or so without having any cash flow in the system. It is a prudent call has been taken by us to dilute some stake, get the partner in, get the cash flow in, and kick off the project. That is a better deal for us as of now.
I mean, you're right. See, again, I would like to set the expectations. Right now, I keep saying this, that our real estate division is like a glorified EPC. We do not want to be putting our own equity or borrowing much on these projects. So we will be looking at methods where we have an equity partner, and then we will execute the project. So our margin might look lesser than what you would expect from typical real estate where the land is in your city. And in this case, anyway, as I said, this was important for us to get out of the Goa hotel, which was not at all liquidatable. And at least we are now on a project where we will execute and liquidate our stake and get the cash flows to move ahead.
Okay, thank you from my side.
Thank you. The next question is on the line of Dhananjay Kumar Mishra from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity. Sir, you said that current BG limit, working capital limit is about 300 crore. So what is the current utilization? And I mean, in EPC segment, when other contractors has delivered very good result, while we have grown just 6 to 7% despite having order book. So this is because of constraint from BG limit, or this is normal growth we would have done anyway?
No, so as I said, this was the order booking last year was just enough to sustain the execution run rate. It was not enough to grow drastically, and that the reason for that was the BG limit. The 300 crore limit is almost fully utilized, but now we've got a 40 crore added limit. The 300 has a 40 crore limit which is unutilized. So now we are in a position to bag at least 1,000+ crores of order book using those limits, and we are working on it. And we are actually at an advanced stage of discussion in a few projects. Hopefully, as I said, in the next few weeks we can expect some news from us. And that will then help us grow. So we are expecting our quarter 3 and quarter 4, because few projects that we bagged early this year in January and Feb, those needed environmental clearances, tree cutting, etc. These are in process. They are almost done. So we expect to start work on the Pune Police Housing in September, and also on the PMRDA project that we bagged in September. So both of these will give us added revenues in Q3, Q4 compared to last year. And so that is why we hope to, catch up. You're right, we've just grown about 7% in Q1, and Q2 might be pretty much similar. But Q3, Q4, we expect our run rate to be more than last year.
So overall for FY24, what kind of growth you are expecting in EPC?
So we've been talking about 10 to 15%, so we expect this year the growth to remain in that range. But next year, we intend to jump straight to 1,000 crores for the EPC.
Okay. And coming to GMP business, which had at least, last few quarters had a run rate of 75 crore, but this quarter it has come down to 58 crore. So any seasonality in that business, or if you can explain?
So real estate business, I would advise, we do not look on quarter or annual.
No, I'm talking about GMP business, not real estate.
Oh, sorry, GMP.
75 crore run rate was there in quarterly basis, but this quarter we have done about 56 crore. So any seasonality in this business, that was asking.
Okay. GMP, there is a marginal change in this quarter as because there is some back-to-back big order, some decline has been put on hold for some time as because whatever the back-end integration is required from the client side was a little bit delayed. So that's why there is a slight drop in the GMP top line, and bottom line is first quarter is concerned. But we are pretty well placed as in terms of the order book of GMP is concerned. We are better off as compared to the last year in terms of the order book is concerned. And execution capacity has also been increased. So we are just at the last phase of starting operation of another plant also. So it will started operation from August onwards or so. So the run rate will be continued, and we are expecting on year-on-year basis, if you compare to the last year performance on JMP, we are expecting almost 10 to 15% growth in the top line and almost 20% growth in the bottom line. So our order book and everything is very well placed to take this thing up. But first quarter, due to this slightly stoppage of the back integration of the client, slight bit of blockages happen in terms of the GMP concern.
Or any plan of monetization, any development on that front from GMP?
Which one?
Selling this business. So what is any plan as of now?
So there is always a mandate in the market. We are looking for suitors, but we did get one or two offers which we were not happy with. So we've not accepted those offers. We will wait for the right offer, and then so that process is a parallel process. We do have a couple of merchant bankers working on it. Whenever we feel there is a suitable offer, we will definitely look at it.
Okay, thank you, sir. That's all from my side. All the best.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Vikram Damani from Damani Securities. Please go ahead.
Hi, good morning. Am I audible?
Yes, good morning.
Hi, congratulations on a decent set of numbers. I just wanted to know how much land in total do we have in Thane?
We have a 45% stake in an entity that owns 150 acres.
And who is the other 55%? Who is the holder of that?
So 10% is a strategic investor, another 45% is an HNI from Mumbai.
Noted. And if the government land does pass through this parcel, how much of this 45 acres, how much of this 150 acres would be sort of going in the road? And do we have a estimation of that?
Yeah, I was told it is about 40 acres, 40 odd acres that would go in the road.
Perfect. And this 150 acres is contiguous or it's split into...
No, 150 acres is not contiguous. That is the reason that, we are not monetizing it straight away. It is, there are gaps in between. So it's quite a few pieces of land in that location.
Noted. Thank you so much. All the best.
Thank you. The next question is on the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you. Thank you for the opportunity. I wanted to know if all your real estate projects, the EPC orders come to you or they are also executed outside?
So wherever we have partners, a process of, initiating an arm's length quotation and discussion always happens. So far, we have managed to bag, wherever we are in the driving seat, of course, we get the first choice of refusal. So far, actually, all these orders have been coming to us.
Okay, no, because in your pipeline, there are 4 projects, and I see only Santa Cruz as, part of the order book, not, for example, the Pashan Bane with 750 crore sale value. That's not part of your order book. So I'm wondering what is the reason? Kalyani Nagar is not part of your order book. So
what we do on the EPC side for the order book is only when a real estate project is launched. And, effectively, we look at it that when we have been given a contract as a contractor, it's an internal document we create where the real estate department internally asks us to start work and signs off on an initial budget. So I think we don't reach that point on any of our real estate projects. We do not include those as an EPC order yet. But you are right, these will come. Santa Cruz, we are in control, same as Kalyani Nagar and same Baner Pashan. Here the partners are not active and the powers are with Vascon Real Estate to choose the contractor. And so we will, in all likelihood, back these orders. There's no reason why we will not be constructing these. We will bring them into our order book at the right time.
Okay, so this will become part of it. So your order book would go up by almost 1,000 crore because of this.
Yes, 500 crore internal order is very much in hand over the next 8-12 months when these projects get launched. This will add up to our EPC order book internally as well. You're right.
Okay. In the past, Vascon was very well known for, doing real estate projects for developers. But your presentation talks of doing more government work. So what is the reason for this shift? You don't, and I mean, in the past, of course, there was a risk with developers, but now developers are well capitalized. So you think you should get back into that kind of segment?
So, we are open. What happens is we feel, in our own study as contractors, if we get to choose our clients, and at this point of time, it looks like a big government project where we have, to understand something, over the last 25 years, Vascon has accumulated pre-qualifications, which sort of cuts off quite a bit of competition when we fight in government projects. Whereas in private projects, it is up to the management of the company to decide whom they want to include in the tender. And so we feel that as long as we are able to bag, we are now in the range where we are able to bid for projects close to 400-500 crores in the government sector, whereby the competition is slightly lower as well. So our focus is that unless our order booking is not getting fully subscribed by exposure to this kind of bigger government projects, and when we come to private, then we would rather look at the kind of private projects that are either industrial or big commercial IT parks, which generally have their funding in place when they decide to construct. Because the risks of non-payment and risks of disputes during the project are much lower that way. We are not averse to looking at builders. We do have a team which is focusing on that as well. But there we would then be putting our terms forward. We have very constrained, limited bank guarantees, and so we do not want to be putting up bank guarantees to a private builder project. So whenever they insist on those things or those terms, sometimes we end up backing out. So to tell you the truth, builder projects are still maybe third preferred clientele for us. As long as we are able to get projects from number 1 and number 2 preferred clientele, builder projects, as long as if it's coming at our terms and our rate, we'll pick it up.
But in other government projects, you need to give bank guarantee, right? And you are constrained by your bank guarantees are fully utilized. So getting new orders becomes difficult. So
yes, you're right. We do try to negotiate projects where we can avoid the performance bank guarantee so that our order book can increase without the bank guarantee limits. So that process is on. We did do that. We got a project from Vedanta without putting up a bank guarantee for the performance, and we are doing with state builders. So whatever private projects we are doing, if it is avoidable to, if we are able to negotiate without performance bank guarantee, we do that.
So eventually, in a larger mode, what you can say that from the builder fraternity, Vascon is the most preferred builder for us as compared to any other builders.
Okay. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. We'll move on to the next question. That is on the line of Rusmik Oza from 9 Rays Equi Research. Please go ahead.
Hi, good morning. I just wanted some more inputs. You mentioned, that around 40 acres of the Army land can go for the road project. If we sell this 40 acres to the government, what could be the realization which we can expect?
So I think the current values, ready reckoner values of land in that region are 3 crores. It was 3 crores a few months ago, so maybe 3 crores or upwards. And the government typically gives, more, sometimes double of those while acquiring. So, but we do not have a firm offer, or the discussions haven't started. But yeah, we can expect, 5-6 crores at least.
Okay. And you mentioned some figure I missed out. What kind of outlook in terms of revenue you were looking for FY25? Because you said you want to start FY25 with an order book of 3,000 crores in the EPC business. So what could be the revenue run rate of EPC business in FY25? And since your real estate also pick up sales, booking everything big time in FY25, what kind of revenue run rate you're looking at from the real estate in FY25? If you can just give us some figures that will be helpful. Thanks.
Yes, so for the EPC, I stick my neck out and say we are targeting FY25, we want to touch the 1,000 crore mark of third-party execution, or rather EPC execution, internal and third-party. And as far as real estate is concerned, we're launching quite a few projects this year. But again, FY25, some of them might not get completion. Still, we expect completion for a couple of projects. We should do, upwards of 150 to 200 crore in FY25 from real estate. And from FY26 onwards, that run rate should be steady and continuing to grow.
Okay. Thanks. That's it from my side.
Thank you.
Thank you. The next question is from the line of Ramanan from MK Ventures. Please go ahead.
Hello. Yeah. I have a couple of questions. One is on the real estate side. When we talk about commercial projects, these are commercial projects that we would sell or we would lease it out. One. And the second is, can you give some light on the JDA projects that you have? What is your share in terms of either area or revenue? And what would it be in terms of the existing under development as well as the pipeline?
So the second question first, the JDA share for each project is different. I think that is shared in our investor presentation, or if you do not have, we can share detailed numbers if you get in touch with us offline. Each project has a different JDA share, depending on, landowner share, and sometimes we have an equity partner. Your first question on commercial, as far as Vascon is concerned, we launched a commercial project in Kharadi. We intend to launch one in Baner. But we are not in the business of holding commercial assets and leasing them. Even if we at all have a leasing model, we would lease and then discount the lease and sell off the asset. So we do not intend to hold on to commercial assets. We will develop them, sell, and exit.
Okay. So just on the pipeline, on the JDA thing, what I don't have is the pipeline one. So what you have indicated is Vascon share, is it? When we talk about Kalyani Nagar, both?
Yeah, what we indicate in our presentation is only Vascon share. If you want all the details, we can, if you can just get in touch with us, we can send across Vascon share. What we indicate is Vascon share, yeah.
Okay, fine, yeah. That's fine, yeah. Thank you so much, yeah. And all the best, yeah.
Thanks.
Thank you. The next question is on the line of Rishikesh from Robo Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. So we said around to the one previous participant, around 150 to 200 crores of real estate revenues. Are we seeing on reported basis for FY25?
Yes, on the balance sheet, yes.
So this is like what will be reported on P&L in FY25, right?
Yes.
And on that, what margins are we looking to do? EBITDA margins?
As I said, for us, gross profits in real estate are closer to 25 to 30% typically.
Okay.
Gross profits, EBITDA would be 15-18% or so.
Okay. And for EPC business, what revenue are we targeting for FY25? I just missed that number. 1,000 crores?
Yeah, we're targeting that.
Okay, and on that, what kind of EBITDA margins are we targeting?
Again, in EPC, our gross profits would be in the range of 13, 14, 15. End of the day, we are hoping to reach a number of 9, 10 as far as PBT is concerned.
Okay. And also, sir, could you bifurcate what debt do we have in real estate and in EPC?
The only debt that is in EPC is a 60 crore CC limit, 63 crore CC limit. And that sometimes, when we report on numbers quarter on quarter, sometimes it's fully utilized, sometimes it's not fully utilized. So that part we'll have to check. Balance debt belongs to the real estate.
Okay, got it. Thank you very much.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Prashant, an individual investor. Please go. Mr. Prashant, your line is in the talk mode. Please go ahead. Mr. Prashant, your line is in the talk mode. Please go ahead. As there's no response from the current participant, we'll move on to the next. That is on the line of Ramanan from MK Ventures. Please go ahead.
Yeah, sorry. Just one more question on the real estate side. When we see the segmental data, I think we have a revenue of about 6.5 crores and EBIT of about 6.3 crores. Whereas, of course, in the presentation, which probably includes the joint venture revenues as well, there it is 10.9 and 4 crores. So, what is the difference in the two? I mean, one is there any capital gains in this? What is it like? The segmental numbers?
What is the real estate revenue for you, Concall? This quarter? Real estate revenue this quarter. Okay. So I think, there is a share of profit from a company called Ajanta, where we are partners.
Correct.
So the difference would be that. So that from that entity, we do not get the top line. We get only share of profit.
Okay.
So in presentation, we add it up, and so that looks as revenue. So that would be profit, which also adds up to revenue, but it totally adds up to the profit itself.
Okay. The only thing is in this segmental, we have 6.3 crores as a EBIT, whereas if you look at the presentation, there we look at EBITDA of about 3.99. It's say 4 crores. So,
yes, I think that
is there a loss in some other entity?
Share of profit that is coming from Ajanta.
Okay. Okay, fine. Yeah. Thank you.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Hello, sir. Thank you for the opportunity. I was going through your presentation, right? The real estate projects that are in pipeline, do we expect to launch this in FY24? I mean, all these 4 projects, Santa Cruz, Baner.
Baner is expected to be launched in this current financial year.
Sorry?
Yeah, Baner, Santa Cruz, yeah. We will be launching it in this financial year.
Okay.
Ajanta will be probably next year. That's okay.
In general, when this project gets launched, what is your, percentage of booking that happens? I mean, for every real estate company, they have got this, right, 25 or 30% that comes in launch itself. What is your rate, I mean, historically?
Yes, about 25 to 30%, in fact, more than 30 sometimes, 35% we do end up booking when we launch.
Okay, right, got it. For FY23, when I went, I went through your segmental, and we have reported a huge chunk in real estate development. If I'm not wrong, we won't be repeating similar performance in FY24, right?
That's right. We do not have enough completions of projects in FY24. Couple of 3 projects got completed in FY23, and therefore we saw revenues and the associated profits being reported last year. This year we do not have completions happening on any of our projects. So what revenue will come would be any additional sales on already completed projects, which is not much. We do not have much inventory, and therefore we are not projecting. Honestly, we will not see a huge number to do with real estate top line or bottom line in FY24. But in FY25, that again we will be getting revenues and bottom lines.
Okay, so that is fair enough. And how many more quarters do we see getting us tax advantage? Means we have to start paying tax at some point of time, right?
Yeah, this year we will unfortunately have to start paying tax, I guess. I think we will be finishing our, carry forward losses this year.
Already done. Some minor portion is left out.
So from next quarter onwards, our PAT will be different to PBT.
Right. So we would be in 25% tax bracket?
Yes.
Correct. Okay, sir. That's all from my side. Thank you, sir. All the best.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Prashant, an individual investor. Please go ahead.
Hello. Am I audible?
Yes.
Yeah. So my majority of my doubts have been cleared. Just one small thing relating to your debt. Last quarter we ended up with a debt of debt of around 12 crores, which this quarter has gone up to 48 crores. And so basically, borrowings from two entities, Aditya Birla Capital and Prachay Capital, have increased. My question is, I mean, since we are also borrowing from banks like UBI and CSB and others, why would we go to NBFCs? I mean, is it a cost advantageous, or how does the cost compare with the banks?
Basically, let me explain you. Your point is very correct. Last quarter, we have a net debt of 12 crore. This quarter, it has been increased. The point of increment is substantial. Almost, if you look at 20 to more than 20 crore, and there has been increase in the utilization of the CC limit put together GMP and Vascon. But at the same time, yes, there is some enhancement of the Prachay Capital. But we explained earlier also that this Prachay Capital loan, though we are getting a cheaper rate at the bank and all these things, but still we are forced to take this Prachay Capital. But it is our requirement to take the Prachay Capital, as because this fund has been utilized for tying up with JV, who is the landowner for another project, which is quite a bit advanced stage. Announcement and everything will come at an appropriate time. But JV and JD and all this kind of investment were required, then bank finance is not available. So you have to go to the NBFC only. So that's why it is a prudent call has been taken. So business opportunity is quite higher. And still compared to any, and it is more of the top of this thing is unsecured loan. So that's why we took some conscious call to go with some unsecured loan to tie up with further JV, which will enhance our real estate portfolio further.
And in terms of costing, I mean, the cost of borrowing, how much would be the differential compared to the bank borrowing?
It will be around in the range of 3 to 3.5%.
Okay. Thank you, and wish you all the best for the coming quarters.
Thank you very much.
Thank you. The next question is on the line of Tushar Sarda from Athena Investments. Also, we would like to remind participants that you may press star and want to ask a question. Mr. Sarda, please go ahead with your question.
Yeah, thank you for the opportunity again. I wanted to just check on, you had plans to divest GMP at some point of time. So what is the status there and what is the current thinking?
So the plans remain intact. We have a mandate in the market with couple of merchant bankers who are looking for potential suitors. In fact, we did have a couple of offers this year, but honestly, it was nowhere near what we were hoping to get, so we did not take on those offers or negotiate further with them. But the process to try and find a suitor is continuously on. Whenever we have a suitable number on the table, we will negotiate and close.
So any other way to monetize it, say through a IPO or something?
We are also, the merchant bankers are also looking at the possibility of an SME or a IPO or, but I think what is important for us is can Vascon liquidate their stake, so sometimes you can list, but will we have enough, we are 85% shareholders, so would there be enough traction for us to be able to sell and exit is something we want to assess before taking any such calls, because we still feel a strategic investor, an MNC international investor. There is a lot of potential in this company because with the amount of Make in India that is now finally, starting to take shape with the Foxcons of the world coming to set up semiconductor industries here, and a lot of these industries will be needing clean rooms. GMP is, 90% exposed to clean rooms in the healthcare center, but it doesn't take much of tweaking to be able to supply clean rooms to the industrial sector, to the semiconductor sector. So they are working on it, and based on that kind of growth horizon available in that industry, which is humongous, the number of factories that people intend to be putting up. So we feel that GMP will definitely have a strategic investor at some point who will look at the bigger potential and offer us a fair price, which we will then take up and exit.
What is the kind of realization we expect or monetization that we expect from this divestment?
So we think we can easily get anything upwards of 200-250 crore equity value for the company, and then our share would be 80-85% of that one.
Oh. Okay. Thank you. Thank you.
Thank you. Ladies and gentlemen, that is the last question. I now hand the conference over to Dr. Santosh Sundarajan for his closing comments.
Yeah, thanks everyone for the interest and the participation and the faith in the company. We are definitely looking ahead to, consistent performance over the next 7, 8, 10 quarters. We can see the order book in hand or the ability to bag order in hand to ensure that we continue to grow over this period. And I'll see you again next quarter. Thank you.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Vascon Engineers Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.